All right, hi everyone. I'm just going to do another market update after the first trading day for the week. So market came off yesterday. It opened the day negative over here and then it tried to climb its way back up, but only to end the day much lower by the end of trading day. Now, what does this all mean when it comes to the market right now? So I just want to bring some things to your attentions based on what I've observed with what the market has done. Yeah, all right. Now, so let's quickly take a look at the end of the first trading day for the week and what do we need to prepare ourselves for the remaining days to come in this week itself, yeah, when it comes to the markets. Now, so the first thing I want to talk about today is really about a quick market update and what we need to pay attention to. And, the question about where the money is really moving, all right, because what we see yesterday is money moving out of certain sectors over here and moving across the board into other sectors itself. So I'll just bring it into your attention in my market updates for today over here. All right, and of course, the next thing will be investors are always going to be concerned. Hey, Terence, what do I need to watch out for? What do I need to beware with if I'm still going to invest my money out there in the markets today? Yeah, right now. So let's take a look over here. Now, so what I want to talk about really over here today is this. Money is moving. All right, now, what do I mean by money is moving over here? Now, so what we see yesterday over here in the markets, let me pull out some of the websites that I prepared for this session. Right, if you followed my last market update over here, you would have noticed me talking about this thing about money moving out of the financial sector itself. Now, so I'm just going to use the whole sector in general as a whole. So what we'll do over here first is we'll look at the ETF, right? The ETF for the financial sector, as you can see on my screen right now. So when we talk about ETFs for the financial sectors over here, what I really want to bring to your attention now is this. If you look at the charts over here, what we are seeing over here is the XLF, yeah, all right, which is the financial sector ETFs over here. And if you can look at my mouse right now, it's been facing some selling pressures. And of course, yesterday, all right, we're seeing more selling when it comes to the financial sector itself. And this is coupled together with also the technology sector itself. All right, because if you look at what we have yesterday, we saw Facebook, we see Amazon, we see Google's all coming down over here. And in my last video, I actually mentioned about this. I talk about the combined market cap and the risk when it comes to the big tech over here. It's really Apple, Amazon, Microsoft, and Google. Now, if all these companies were to be falling, that's almost 1, 2, 3, 4. Yeah, that's almost $4 trillion of market cap in the S&P 500 that is dragging the whole index down. All right, and you can see if financial sectors are going down as well yesterday. So we have JP Morgan, we have Visa, we have Wells Fargo, and we have MasterCard. Yep. All right, now, so this also makes up pretty much the top 20 market cap when it comes to the S&P 500 index components itself. Now, so if you have these two main stocks and main sectors over here that is dragging the market down, so it leaves you imagining why, really the drop is only just 20 points. Yeah, all right, it's slightly just about 1% in the marketplace yesterday. So let's let's take a look further into what we are observing over here when it comes to the market and really the threats that we need to pay attention to over here. Right, because the S&P dropped slightly less than 20 points over here. We are sitting at about a market close where the S&P 500 dropped about 16 points. Yeah, all right, so that's actually slightly under 1% actually. Yeah, all right, now, but what we see over here is the technology sector or the FANG stocks over here, and of course the financial sectors that's moving. Now, so what's happening over here is, if you put money in your unit trust, it's an ongoing basis where banks all around the world itself collects money from investors, and these money needs to go to work. Now, so when these money needs to go to work over here, fund managers needs to find stocks that they can put the money into. But what we see yesterday is clearly the fact whereby they're moving money out of these big tech sectors where they've really been performing really well, and maybe they start to feel that there's a little bit of risk or overvaluation going into these stocks in the short term. So they're moving money out by selling some of the stocks or mainly Amazon, Apple, which has been doing really well in the recent times. And what they're doing is they're moving money out of these stocks over here, and they need to put it into some other stocks. And what you see yesterday is you see a lot of defensive stocks, all right? The ones that you don't really see moving up much up these days over here. The defensive stocks are, what we more generally call them as consumer staples. Yeah, all right. These are the stocks that benefited from the selling in big tech and financial sectors over here. Now, so money moved into those stocks, and those are the ones that kept the market, sell off in check, basically. Yeah, all right. So in our terms over here, what we're seeing is money is moving out. All right, money is moving out of the risk sector over here into what we call safety or defensive sectors. Now, this means that fund managers are seeing a little bit of short-term risk, or at least some corrective move in the near term. All right, and they're trying to move money into more defensive sectors so as to avoid a big sell-off or a big hit on their portfolios over here. All right, and of course, the next thing that we've been talking about for the longest time, and most of us in the stock market would be knowing, all right, which is the interest rate factor. All right, interest rates are on the rise in the US, and these are putting some pressures into the markets because when interest rates are going up, and more consumers, especially in America, are putting their purchases on debt over here, be it credit card debt or loan debts over here. When interest rates keeps going up, it will affect their repayment schedules, and once these repayment schedules are affected and they're behind time over here, what's going to happen is in the long run, people are going to shop less, people are going to buy less because they now have less money, all right, having to meet the demands that they have overswiped in the past, and they're playing catching up, all right, and this will negatively affect the revenues that these companies are making, and all these will flow back into the stock price after a little while. All right, now, and of course, the last thing I want to talk about over here is really volatility. All right, now, we see a lot of sell-off these days every now and then. Every other day, we see a certain sell-off. But the weird thing right now is the volatility in the market is not taking off, which means what we're saying right now when I say this over here is you see down days, but you don't see the volatility really spiking, which means that there's still a lot of calmness in the market. People are not panicking yet. Can you imagine what happens when people really one day start to switch on and starts to panic? Yeah, all right, which means they're not only selling the tech sector, they're not only selling the financial sector, but what we're going to see is we're going to start seeing selling across the board, basically. That's what I'm trying to imply. Once you see selling across the board and across all industries over here, then you're going to have those 30 points, 40 points down days on the S&P 500, and we're really not going to be sure of what the market has in store from there, and that's when the volatility is really going to spike from there. Now, so having said all this over here, these are certain things that you want to pay attention into over here, going into the markets for the remainder of the week. Now, so let me move into what I really want to talk about over here before I finish for today. If we look at the end of the week expiry over here, let's say 21st September. All right, now they're based on the implied volatility on the options over here for the S&P 500 index, which is the SPX itself. Now, so what we're seeing is with 3 days left into expiry over here, there is still an expected move on the index itself for around about 30 points. All right, we witnessed about a 16-point drop yesterday, but market is still predicting that we'll see another 30-point move up or down from where we are today. So I'm not saying it will go down another 30 points, but we can expect that to happen, or market could really rebound back upwards 30 points, or it could just stay somewhere in the middle for the rest of the week. But one thing we're definitely not seeing over here is the volatility index, which is the VIX over here. All right, it's really not been moving much. Yeah, all right. So after yesterday's move, it's still not been moving much. So we're going to expect a lot more volatility to come into place if selling continues for the rest of the week. Now, so position yourself safely over here, put yourself in the right stocks, the right sector, and make sure you control your exposure over here for the rest of the week in the markets. And here, all right, I hope this benefits all of you over here with my market updates. And yeah, do follow our YouTube channel over here if you want to continue to receive more updates on whenever I put up a video next. All right, thank you very much.